So the 10-year yield went through an important threshold at 3%, and stocks didn't respond that great. What do you think about that?
So I think people, the benchmark 10-year, the 3% that people are looking at, there's a lot of focus on. I think it's a big deal, but I think it's a big deal that yields are moving higher. I actually think the front end of the yield curve has become an alternative. The front end of 2-year, now at 250, is creating an alternative. It used to be, actually, I got to buy utility stocks, I've got to buy preferred stocks. Actually, I can do really well sitting in the front end, not taking a lot of risk. It used to be my cash is getting zero over my front end. Now it's changing the paradigm. Going through 3% is a big deal. I don't think we're going that much higher. I think we'll go, we've said 3.25, maybe 3.5 this year. But yields are moving higher. I think people have to respect that. And do you own equities? Do you own debt? Debt becomes a more attractive instrument.
And when you're more excited about the front end, can you talk more about your thesis there?
Yeah, I mean, it's an amazing thing. We are now creating a dynamic. So people talk about the issuance and how much Treasury's got to issue, and what they did last month is almost $300 billion worth of bills. It's too much. The market can't absorb that much. But what's happening is not only they're issuing a tremendous amount, but it has real yield to it. So what's happening now is not only is the Treasury issuing this massive amount of debt, but it's got an income. It was one thing when they were issuing Treasury bills at zero for years. Like, it's not that. Now, gosh, I can get bills at close to 2% or maybe even a bit behind that. It's really powerful, and you've changed the whole investment paradigm. When you construct a portfolio, or if you're an investor, and it used to be, my God, how am I going to get any income on a portfolio? Well, now I've got an easy way to do it without any risk. That is a big deal.
And how does that compare to equities or other assets?
Yeah, so what's happened now is you take the dividend yield of stocks and you look at where it was, and the dividend yield of stocks was really attractive relative to Treasuries, but for years, that wasn't the case. Now, all of a sudden, things like utilities or things like that, all of a sudden, you're compressing that. By the way, it doesn't mean people should own equities. We think equities probably will go higher from here. But the need to get more into your portfolio, by the way, you're getting closer to the end of a business cycle. We think equities still have some more upside, but what's happened is you've changed the investment regime quite a bit. And I think that is such a big deal. And I just don't think people don't talk about the front end of the curve. And the front end is where, we look at our portfolios like, gosh, I could buy commercial paper, I could buy some front end assets. All of a sudden, I could do well with that.
And what about inflation when you're watching the Fed? Are you worried about inflation?
So, I would say, we think inflation's going higher, but we're in a completely different regime than anything anybody's ever seen before in history. We think CPI, core CPI, is going to peak at about 2.5%, maybe a little above that. Core PCE, which is the Fed's favorite metric, it'll be about 2.2. But you think about the growth that we have in the economy today and where wages are accelerating. Historically, you would see numbers dramatically higher. Listen, we've spent, so no, I'm not that worried about inflation getting out of control. We talk a lot about technology, this incredible headwind keeping inflation down. Every time you think inflation is going to go higher, you see another development in transportation or energy or food that just presses down on it. Listen, and you go back years and think about if you got this sort of growth, this sort of wage acceleration, the rate of inflation would be much higher. And the Fed has spent no time, the economy's spent no time above 2% in the last 6 years. The Fed's not that scared, not that nervous about, gosh, if we get 2.2 or 2.3, who cares? I mean, it's not that big a deal. So they'll just keep going on their moving 3 to 4 times this year, 3 to 4 times next year. No reason to speed it up, which they've said publicly, which is part of why in the front end of the curve, if they're not going to speed it up, much of it's gotten priced into the market. Well, we feel pretty good about that. It's just not that scary inflation. When people look at history and let's look at the traditional economic models and said this sort of growth, this sort of wage, 4% unemployment rate, my God, you're going to see this sort of inflation. Just not like history.
And given the shift in technology and where you see inflation going or how things have changed, is 2% the right inflation target for the Fed? And where did that come from originally?
No, it's just not. I mean, so is inflation the right metric over 50 years? Definitely. And is inflation over a long term? There is, to get companies to have some pricing power and inflation expectations and belief that if you invest that you'll get some appreciation from inflation. But if you think about what I think is the greatest revolution of all time in technology, that it's not the technology traditionally. When you think about whether it was lighting or automobiles or transport, things like rail, et cetera. What it did is it created this incredible growth engine. The technology today is designed to do what we used to do at a fraction of the cost. You think about autonomous driving. You think about how we produce food. You think about how we produce energy today, about horizontal fracking. Everything we used to do is an app on your phone that you used to do the same thing at a fraction of the cost, meaning why is 2%, there's any magic to 2%? In Europe, you can't get above 1 in an environment where their growth has been well above potential. Meaning, I just don't think, and it's part of why I don't think the Fed would be that worked up if we got a little above 2, because you're going to come back down to, particularly as the economy slows, you'll get back under 2. So, what is the right target? Why can't, if you get real growth in the economy and you grow at 1.5%, particularly if bad inflation is coming down. What is bad inflation? Particularly think about lower and middle income. If it's food, if it's energy, if it's apparel, if those things are coming down, it not only is that not good, it actually helps the quantity of goods. It helps net disposable income for people so you can consume more and your quality of life is better. So, this target of, I do a lot of work in urban education otherwise, and we talk a lot about inflation and we talk a lot, people don't want higher inflation, but give me something that's stable so their investment comes in and the bad inflation comes down.
And how do all of these things play into what's your outlook for the market? For stocks,
So,
I mean.
Yeah, so I think equities, the era of where can equities go, you're going to get these supercharged returns, I think is finished. We're getting closer to the end of the business cycle. I don't think, I look at free cash flow yields. Free cash flow, companies throwing off a lot of free cash flow. There's still, I look at where the cost of finance, if you're a company to finance it, there was an incredible arbitrage of companies who buy back huge amounts of stock. Not that great today. But can you get an 8 to 10% return this year in equities? I think so, and I definitely think you do that, particularly post the tax bill. But I think what people have to think about, how do I get in this era, in 2018, they have to bring down their return expectations. Boy, if I can get 8 to 10% in equities, if I can carry in fixed income, and there are ways I can get 2 to 3% in fixed income, that I could throw off a mid-single digit return, life is good. And I think that's the world we're living in. We're not going to get 25% in equities anymore. But I think companies are there, you look at the earnings numbers, the ROEs they're throwing off, they're pretty impressive, and the free cash flow that they're throwing off, and they're still buying back some stock. But I just think the world is different. It will be different in 18, it will be different in 19. Try and hit a mid-single digit return, and what's the most efficient way to get there?
And finally, was there anything that keeps you up at night? Is there anything you're worried about for a fixed income portfolio or an equity portfolio?
So I don't sleep much at night, so that's a hard thing to start with. But I think listen, the biggest risk in the world continues to be, China. How does China grow? China's 42% of growth in the world today. This trade discussion around how it works out with China is a bigger deal than people give credit to, because they're literally 50% of the demand in the world for commodities, iron ore, nickel, aluminum, zinc. So, the extent that China is growing, the global economy and trade is working, is a very big deal. So that is something that I think, and it feels like the momentum is moving to a better place, hopefully, in terms of the trade. Anyway, that's one. Listen, I think the world has gotten short volatility for a long time, and that could be in different expressions. How do I get income in my portfolio? I'll use beta, I'll use some of the high yield market, I'll use short volatility, I'll create leverage in my portfolio through margin, et cetera. Some of that, this extreme volatility you've seen beginning of this year, is some of that's getting wrung out. More of that has to get wrung out. So how that transpires, we're going to live, 2018 is going to be higher volatility, no doubt, and what's happening now is the Fed is draining liquidity from the system, and the Treasury is issuing tremendous amounts, so they're also taking liquidity out of the system. That means volatility is going to be higher. So, how do you operate effectively? How do you build a portfolio, that with things that keep you up at night, but give you less volatility? What will be a higher volatility environment?